The Nasdaq is closed, and the closing price for SoFi Technologies Inc. on Friday, October 17, 2025, was $26.54, reflecting a modest drop for 0.23% for the session. While the immediate chatter in the markets tends to fixate on this slight daily dip, or the recent pullback from the 52-week high of $30.30 set in late September, the more consequential story lies beneath the surface in the institutional ownership data, which is hinting at something the average retail investor isn't fully appreciating yet. Specifically, recent 13F filings from the end of the last quarter show that despite a flurry of negative analyst sentiment and some short-term price consolidation, the overall institutional picture is one of continued accumulation, with new positions and increased holdings far outpacing sold-out and decreased positions. This quiet confidence from large funds, the smart money, if you will, contrasts sharply with the day-to-day anxiety expressed in the price action and social media commentary, suggesting that the underlying structural growth narrative of SoFi is holding up better than the current chart might imply. The general market expectation for SoFi, a perception built over the past year of significant growth, is that it is a high-momentum technology stock that must perpetually expand its member and product count at breakneck speed, or its premium valuation cannot be justified. This narrative sees the stock as highly sensitive to interest rate hikes and broader economic health, a classic high-beta fintech play. The expectation, therefore, is for massive volatility, with every piece of news, positive or negative, leading to an outsized move. For instance, the stock's recent single-day drop of 5% following its pullback from the high was widely attributed to simple profit-taking, a move that fit the high-volatility, momentum-driven story. However, the reality of the business's fundamentals suggests this common narrative is incomplete and perhaps misleading. The true story is not just about hypergrowth, but about a calculated and successful shift toward a structurally more stable, capital-light, fee-based operation, a reality that offers a higher degree of risk mitigation than its initial growth stock label implies. Looking at the more immediate stock movement, the decline from the $30.30 high was swift, representing a nearly 12.5% correction in a matter of weeks, a move that liquidated a significant amount of speculative interest. This is a normal and often healthy phase for any stock that has seen an explosive run, as SoFi has, surging over 160% in the last year alone. Volume has remained high, with the average 20-day trading volume hovering around 64 million shares, which is significant and suggests robust, albeit two-sided participation. The market is clearly wrestling with the valuation following this massive run. Technical indicators such as moving averages have been flashing sell signals recently, reflecting the short-term downward trend, but the relative strength over the past 4 quarters remains very strong, placing it in the 96th percentile of U.S.-listed stocks for momentum. This highlights the disconnect. Short-term technicians are bearish on the correction, while fundamentalists recognize the long-term relative strength. A crucial development that goes against the pure fintech narrative is SoFi's deeper integration of its Galileo payments platform with Amazon Web Services, a partnership announced recently that allows firms to scale financial experiences on AWS infrastructure using Galileo's technology. This is significant because it reinforces the B2B tech platform segment of SoFi, providing a stable, high-margin, non-lending revenue stream that is often overlooked when investors fixate solely on member counts and personal loan growth. It's this move, alongside the expansion of its own options trading services, that illustrates the company's continuous focus on becoming a true financial operating system, rather than just another digital lender. Now, let's step back and consider the institutional picture in greater detail. As of the last major filings, institutional holders increased their positions by over 110 million shares, while decreasing or selling out of about 55 million shares, resulting in a net institutional accumulation. Major holders like Vanguard Group and BlackRock Inc. continue to hold significant positions. This is a critical counterbalance to the negative noise you hear online. These large institutions are not trading on a one-day technical dip. They are positioning based on the long-term execution of the bank charter strategy. They are essentially betting that the lower cost of funds derived from the growing deposit base, coupled with the recurring sticky revenue from the tech platform and financial services segments, will eventually justify the seemingly rich valuation multiples, a price-to-earnings ratio in the low 50s and a price-to-sales ratio above 9.0. For those less familiar with the background, SoFi Technologies Inc., short for Social Finance, began as a student loan refinancing firm before obtaining a national bank charter in 2022 and expanding into a full-service, digital-only financial platform. Its core operation is built on 3 pillars: lending, personal, student, home loans; technology platform, Galileo and Technisys, which powers other fintechs and banks; and financial services, checking, savings, credit cards, investing. The whole thesis is based on cross-selling, getting a customer in with one product, like a free checking account, and then selling them 4 or 5 more products over time, a strategy that dramatically increases the lifetime value of a member and reduces customer acquisition costs. They intentionally target an affluent, financially responsible demographic, with personal loan borrowers boasting an average FICO score of 743 and an average income of $161,000. This disciplined underwriting and focus on a high-quality credit profile is exactly what has allowed them to report 7 consecutive quarters of positive GAAP net income, a major differentiator from many other high-growth fintech peers. The recent second quarter results provide the clearest reality check against the expectation of mere speculative growth. In that report, SoFi posted record revenue of $855 million, with adjusted net revenue up 44% year-over-year. Crucially, the fee-based revenue, the stuff that doesn't rely on loan origination volume and interest rate spreads, grew by 72% year-over-year to $378 million. This rapid expansion of fee-based income is the structural transition the market is supposed to be rewarding, as it insulates the company from the macroeconomic risks tied to interest rate fluctuations and credit cycles. The company added a record 850,000 new members, bringing the total to 11.7 million, with products in use hitting 17.1 million, demonstrating that the cross-sell strategy is working. Management was so confident in these results that they raised their full-year guidance for 2025, expecting adjusted net revenue to rise by about 30% and adjusted EBITDA to grow by 44%. The upcoming third-quarter earnings report, scheduled for October 28, 2025, represents the next major test of this thesis. Analysts are forecasting an EPS of $0.08, a 60% increase from the prior year's $0.05. The market expectation is high, largely priced in by the stock's run-up over the last year. The reality that could either exceed or disappoint this expectation will not just be the headline EPS number, but the sustained momentum in the financial services segment revenue and the Galileo platform's new client additions. If the company can demonstrate continued sequential acceleration in member growth and a further increase in its fee-based revenue mix, it suggests the foundation is even stronger than previously thought, potentially triggering a significant move higher, despite a cautious average analyst price target of $22.69 that currently sits below the stock's actual trading price. Looking ahead, the future outlook for SoFi revolves around several key opportunities and risks. The greatest opportunity lies in completing the transition to a full-scale financial institution that rivals the traditional top banks, a goal CEO Anthony Noto has stated explicitly. This involves scaling the member base towards 50 million and maximizing the products per member metric. The main operational advantage is the lower cost of capital provided by the bank charter and the growing deposit base that allows SoFi to fund its lending at more favorable rates than non-bank fintechs. Furthermore, the integration of new services such as the recent options trading expansion and planned re-entry into cryptocurrency and artificial intelligence tools for financial services aims to keep the platform sticky and comprehensive. However, the risks are substantial, primarily concerning competition from incumbent banks like JP Morgan and Bank of America, which are investing heavily in their own digital capabilities, as well as agile fintech rivals. The macroeconomic environment remains a risk. While SoFi targets a high-quality borrower, a deep or prolonged recession could still impact loan demand and credit quality, despite the company's excellent risk management track record thus far. The high valuation also means there is little room for error. Any quarterly miss or slowdown in growth could trigger an aggressive sell-off, which is the tension that makes this stock so captivating. The ultimate question for investors isn't whether SoFi is growing, because the evidence clearly shows that it is. The question is whether its accelerating structural shift to a diversified, vertically integrated, and capital-efficient model is outpacing the high expectations already baked into its current market price. The institutional accumulation, coupled with the clear progress on fee-based revenue and prudent lending, suggests the execution is consistently running ahead of the common belief that SoFi is merely an overvalued lender. This is the reality you need to grapple with when evaluating this company. Comment below how many shares of SoFi Technologies Inc. you currently hold, or if you're waiting for the next earnings report before making a decision. In summary, SoFi Technologies closed Friday, October 17, 2025 at $26.54, slightly down for the day but fundamentally sitting on a much stronger base than its recent high-volatility price action implies. The initial expectation of a pure rate-sensitive growth stock is being consistently challenged by the reality of a successfully executed strategy to become a diversified, profitable, full-service digital financial platform, evidenced by surging fee-based revenue and strong institutional accumulation. The core insight is that the company's growing operational stability from its bank charter and Galileo platform is the true engine of value, a feature often overshadowed by the drama of short-term lending figures. As we head into the next earnings report, the market will be looking for confirmation that this structural strengthening continues, reinforcing the authoritative position SoFi is building in the evolving finance landscape. The ability to maintain momentum in non-lending revenue will be the deciding factor in whether reality continues to exceed the market's already ambitious expectations for this fintech power player.